In this video, we will discuss financial ratios, the relationship between financial ratios and financial performance, and the use of financial ratio analysis in evaluating a company's financial condition. Financial ratios are analytical tools used to measure and evaluate a company's financial performance by comparing different figures in the financial statements. These ratios help simplify complex financial data into meaningful indicators that can be easily interpreted by management, investors, creditors, and other stakeholders. In general, financial ratios are calculated using data from the balance sheet, income statement, and cash flow statement. The main categories of financial ratios include liquidity ratios, solvency ratios, profitability ratios, and activity ratios. Each category provides different information about the company's financial condition and operational efficiency. Liquidity ratios, such as the current ratio, measure a company's ability to meet its short-term obligations. Solvency ratios evaluate the company's long-term financial stability and its ability to meet long-term liabilities. Profitability ratios assess the company's ability to generate profits from its operations, while activity ratios measure how efficiently a company uses its assets to generate revenue. The relationship between financial ratios and financial performance is very strong, as financial ratios serve as indicators of how well a company is managing its resources. Good financial performance is usually reflected in healthy financial ratios, such as high profitability, strong liquidity, and efficient asset utilization. Conversely, poor financial ratios may signal financial difficulties, inefficiencies, or potential risks faced by the company. For example, a high profitability ratio indicates that a company is able to generate sufficient profits from its operations, which reflects strong financial performance. Similarly, a stable liquidity ratio shows that the company can meet its short-term obligations without financial stress. Therefore, financial ratios help stakeholders evaluate whether a company's financial performance is improving or declining over time. Financial ratio analysis is widely used for various purposes. One of its main uses is to evaluate company performance over a specific period by comparing financial ratios from year to year. This trend analysis helps identify patterns, strengths, and weaknesses in financial performance. Another important use of financial ratio analysis is comparison between companies, especially those operating in the same industry. By comparing financial ratios, stakeholders can assess which company performs better in terms of efficiency, profitability, and financial stability. In addition, financial ratio analysis supports decision-making processes. Management uses financial ratios to improve internal control, plan future strategies, and allocate resources effectively. Investors rely on financial ratios to evaluate investment opportunities, while creditors use them to assess creditworthiness and repayment ability. In conclusion, financial ratios are essential tools for understanding and evaluating a company's financial performance. The relationship between financial ratios and financial performance highlights how effectively a company manages its finances. Through the use of financial ratio analysis, stakeholders can make informed decisions, reduce financial risks, and support sustainable business growth. Thank you for watching, and I hope this explanation helps you better understand financial ratio analysis.